So, Martina, this is your second time on the Money Talks podcast, but for people who aren't regular listeners, can you give me a sense of the work that you do?
Yeah, thanks, Katie. Thanks for having me back. So I am a mortgage intermediary and I run a business called Doddl, and we are a mortgage and insurance intermediary. We help people buy their first home, buy their second home, and also we help them review their rates. So we will somebody will come to us and they will want to buy a home, and we will explain to them what the process is. We will give them all of the information they need in terms of what affordability looks like, how much they can borrow, and then we will give them approval in principle so they can go out and actively start house hunting. So we're involved with our clients right from inquiry to when their mortgages draws down, and then after that to review their rates at regular intervals to make sure they're not paying more than they need to on their mortgage.
Okay. How has the mortgage industry changed in the last 5 years?
Oh, well, there's nothing surer than the mortgage and the property industry is in constant flux. So over the last 5 years, I suppose if we look back to maybe just after COVID times, there was a lot of uncertainty in the market at that stage. There was a slowdown in terms of supply of properties to the market, which has been ongoing since. But in terms of the mortgage market itself, over the last 5 years, we've had rates increase quite significantly from 2022 right up to 2024. We've seen lenders exit the market. So in 2021 to 2023, Ulster Bank and KBC Bank exited the market. And then we had new entrants like Moco and Newer Money coming into the market over the last 18 months. So there's always a lot of change in the mortgage market. Rates are constantly changing. Lenders tweak their proposition, what they want to offer clients, and just generally mortgage lending rules. The central bank macroprudential lending rules were brought in 2015, but they were tweaked in 2023 to make them a little bit more flexible. So they're the real, I suppose, changes in the market. Trends then with regard to customers and how people consume. So the new generation, I suppose, of digital natives are really, looking at hyper-personalization. They look for a seamless digital mortgage journey, and they want to be educated. We want to know what we're entering into when we're entering into such a large transaction like a mortgage. So we want as much information as possible, but we also want, when we give some data, to have kind of curated mortgage options and financial product options, tailored to us, offered to us. So that's the role of brokers and intermediaries like myself in the market, in understanding what people need and kind of delivering that new, I suppose, curated and more sophisticated piece of advice to clients who are looking to really tailor their requirements, to their own particular needs.
Mm-hmm. Has the typical age profile or the age profile of the typical applicant changed?
Yeah, so I have been in the mortgage industry for over 20 years. But in the last, I suppose, decade in particular, you'll see the age of a first-time buyer increasing. So the average age of a first-time buyer in Ireland is now around 34, 35, so around the mid-30s. And that's, I suppose, due to a number of different reasons. It's harder due to the cost of living to save a deposit. And the obvious being due to issues with supply, there's huge demand for properties, and property price inflation has been increasing throughout the last decade in particular. So it's more challenging for people to get on the property ladder, and that is determining when they're in a position to do so. In normal course, it has to be where your income supports the mortgage level you need to be able to buy the property in the area that you want to live. So that can be a real challenge, obviously, for people living in urban areas. The average income level is 53,000, but the average purchase price of a home is over 426,000. So that's an 8-time multiple. So that can be hugely challenging for people. It may mean that they have to defer their decision to buy so that they can secure the 10% deposit and save that in a time where rents are hugely high. But it also means that they have to be well established in their career to have that income to be able to support a mortgage, particularly if they're buying as a sole applicant.
Mm-hmm, mm-hmm. So more and more people in their 40s, 50s, and perhaps even 60s going for mortgages.
Yeah, sure. The norm is now that people are not just first-time buyers, but certainly as people have found over the last 10 years that it's been challenging to move home, right? So they've bought their starter home and they go, I'll stay in this home for 5 years. Now because of the difficulty to actually trade up in the current market, people are living in their starter homes for longer, and due to family circumstances and the requirement to have more space, they're looking to now move. So they're finding themselves in a position where they're late 40s looking to buy their second home, or maybe their family home, having outgrown that starter home that they had intended originally to live in for, a short number of years.
Mm-hmm. So that's one cohort, but I'm interested in this idea of the 40-something first-time buyer. Is that something you encounter?
Absolutely, and all the time. Again, in particular for sole applicants, it can be really challenging to purchase a home, to get that deposit, to have the mortgage level or the income level to support the mortgage level you require to buy. And we all know that it's so challenging to purchase a property in Ireland at the moment, and in particular in urban areas, that it's not just whether it's affordable to some degree, it's actually having the ability to secure a property. And certainly a double income helps with that, but not always necessarily. Life gets in the way, and a lot of people who would have commitments now at that level of, the mid-30s, early 40s level, where they have had to push out their buying decision because they didn't have deposits, availability of properties were lower, and their family circumstances now means that affordability is a big question for them. So a lot of our applicants that would come to us, early 40s, would be looking at affordability. They may be able to borrow a certain level, but because the mortgage term they'll be borrowing over is reduced, because age to expiry in general, if you have a pension, age to expiry is up to 70. It means that affordability or monthly repayments, if you're borrowing in your 40s as opposed to when you were in your 30s, does certainly impact your monthly repayment, and how feasible it is for you to borrow at that kind of max potential level that you could borrow based on your income to purchase the home that you want to buy.
Mm-hmm, mm-hmm. Do you think, if we compare to 10 years ago, that the 40-something first-time buyer is looked at more favourably now by banks than they might have been a decade ago?
I suppose, a decade ago, if we were looking at it, like it was the same rules really applied in 2015 as 2025 in terms of purchasing your first home. The same multiples of income applied. I think there's certainly the buyer of today who's in their 40s is much more conservative. Again, they're looking at affordability as being their key criteria. Everybody in that category that comes to us is looking for a mortgage or to purchase their first home needs enough to buy the home that they want to buy in the area they want to live in. And generally, they're more established in that area. But it really does come down to affordability. So when you look at bank statements, they may be seen as more prudent for a mortgage application. You can see that they've had a longer build-up of savings. So that does help when it comes to making a mortgage application.
Mm-hmm, mm-hmm. Retirement age is being pushed out. It's piecemeal, but it's very much happening. We're hearing murmurs of the 50-year mortgage, although it's not particularly, a lot of people would say that's not a great idea. But, do you think there is a chance that this 70 age cap could get pushed out in time?
Yeah, well, as it stands now, like a mortgage by its very nature, I suppose, is always designed to be repaid during the mortgage term, so during the term that it's outstanding. So most lenders will work to age at retirement, so normal retirement age, they'll look at 67 to 68. Most lenders will, unless you have a pension. And if you have a pension that can show that post-retirement, you're able to fund the mortgage repayments based on the pension that you're paying into, then most lenders will go to 70. There are two lenders that will go above the age of 70. Newer Money will go to 75, and then MOCO will actually go to age 80 at retirement. That is where there's significant post-retirement income. So that would be where somebody has a hugely strong pension, or they have a buy-to-let, portfolio. It's not generally for your standard first-time buyer unless there is a really big huge retirement pension pot post the age of normal retirement age. So it's not the standard. It's a really tricky one, because I don't think anybody wants to pay a mortgage into retirement. It's not prudent to do so. We need our retirement funds, and most people haven't got the pension funds to actually, to really maintain themselves in retirement without having to add in the potential for purchasing a property or repaying a mortgage. But the challenge then is when you're in your 40s or in your 50s, or even, some of our applicants could be even in their late 50s, early 60s, and due to different reasons within life, whether that's a marital breakdown or whether they just need to change and move to and take out a new mortgage, they want to borrow over that longer term to reduce their repayments, and they may have a plan as to how they want to repay that mortgage, i.e. maybe due to your lump sum your pension lump sum at retirement age. So it's not, there's never one size fits all, but certainly most people do aim to have their mortgage cleared by normal retirement age, or at least by the age of 70. We don't actually get a lot of requirements for mortgages that go past that max term with most lenders, which is 70 years at expiry once you do have a mortgage or a pension in place.
Got it. So the person who's listening to this, who's in their 40s and is getting mortgage ready to, to buy for the first time, what kind of steps can they start taking? I mean, should they be looking at their pension as the first step if they're going to have to push out the age at which they fully pay it back?
Well, I suppose for most applicants, if they're paying into a pension, it will be naturally that they can go up to the age of 70 at retirement age. They may have in their own mind a plan to actually accelerate the repayment of that mortgage, once they get settled into the mortgage. It's just from an affordability point of view and being able to actually secure the mortgage. They may go over the extended term up to age 70 at retirement. But we will often have clients who will pull back that term, or they'll overpay their mortgage so that they're repaying that mortgage early. And I suppose it's really important to call out that the longer the mortgage term you have, the more interest you repay on your mortgage. So it's always best to be mindful and look at it in regular intervals. As your mortgage progresses, so will your income, so will your commitments. And it's always really, really important to be mindful of how you can bring that mortgage so it is cleared in the optimal timeline, being before your retirement age, your normal retirement age. So I think that's always a really important one to be aware of. In terms of getting mortgage ready, and like for somebody who's feeling that it's really daunting, that they're maybe in their early to mid 40s or later, and they're thinking, okay, is this hopeless? What can I achieve? I think it's really important to be aware of how lenders lend, what you can potentially borrow based on your income, what's affordable for you, because again, affordability is a key piece. If the mortgage term is reduced, your mortgage repayments are going to be higher. So it's making sure that you're comfortable with taking on this new commitment and making sure that it's still affordable for you to repay that mortgage over the shorter term. The other thing I would say is don't rule out and don't forget about those first-time buyer schemes that are in place. So the government schemes that are in place, such as the Help to Buy, the First Home Scheme in particular, if you're looking at new build properties, because the Help to Buy scheme is a rebate of 30,000 under the government scheme, that basically if you pay tax in Ireland, it's a rebate of the tax you paid over the last 4 years. But the First Home Scheme bridges the gap in affordability between the mortgage level you're eligible for, plus your savings and the purchase price of a property. And that can be up to 30% of the overall purchase price. And the difference between, I suppose, the equity piece that's taken under the First Home Scheme and the mortgage repayment is that you don't actually pay the First Home Scheme equity piece back over that set period of time. So it's not like a mortgage. You pay a service charge of 1.75% on the amount borrowed from year 6, but really the amount only has to be repaid on your death or on if you sell the property or move outside of the lenders that are party to the scheme. So it's a really good way if you're kind of thinking to yourself, okay, I have a differential, I just can't seem to get to that level that will allow me to buy a home. That is an up to 30% bridge between, again, purchase price and your eligibility. And also it can help with affordability because it means that you're not paying that same amount, that amount you've taken under the First Home Schemes Act, you're not repaying that over the same terms as the mortgage. So it makes it more affordable. So I suppose understanding exactly what your options are and knowing what the art of the possible is really does help. And most conversations I have with clients who are in their 40s or 50s and who are dreading the conversation and don't know where to start and worrying about what they'll be able to borrow, it ends up being positive in that you understand where you're coming from. You might even be able to borrow more than you actually wanted from an affordability point of view, but it's getting comfortable between that fine balance of how much you need to borrow to buy, because nobody borrows more than they have to, or they have to buy in the area that they want to live in. And also then the affordability piece. What is affordable? And that will allow you make decisions and kind of take ownership of it. Where am I happy to live? Or, I want to live in the place that I'm settled in now, but actually does that come with a really big overhang in terms of the mortgage repayment? And am I willing to, remain rooted in that area that I'm in, or do I need to look at other options, which is unfortunately the case for a lot of people right now. They're just priced out of the areas that they do want to live in, which is a massive challenge.
You mentioned government schemes there. We also touched on separation and divorce. I think it's worth pointing out the Fresh Start scheme, which might, with some people in those age brackets, might be applicable for them and may not realise.
Yeah, it's really important. And also, I would say that the First Home Scheme has also been extended if you want to purchase the house you're renting in. So you've so many people who, if it comes up for sale, so many people who are actually, renting properties that, they've rented them for a decade. And then because of new rules coming in, the landlord is putting the property up for sale. The First Home Scheme can help with the purchase of a tenant purchase, basically, where you want to purchase the home you're currently renting in that is up for sale. So that's just another aside. But certainly, Fresh Start principle is where you are divorced or separated and you have relinquished your rights to the family home. Then you're also eligible for that First Home Scheme, which can really help because, you may have a portion of the equity from the property if you've come to a settlement, but you may not. And again, trying to come up with that deposit level, or trying to bridge that differential, particularly as a separated or divorced individual, if you're a sole applicant, can be a challenge. So not to forget about that scheme in particular. The First Home Scheme is hugely useful and beneficial for somebody under the Fresh Start principle, or again, under tenant home ownership.
Have you dealt with first-time buyers in their 50s?
I have. Yeah, no, absolutely. So, again, people may return from traveling, they may return from overseas, and they may just have not had the opportunity to purchase a home until their 50s. They may just have decided that the market wasn't right for them, or they may be settling into a new area. So absolutely. And again, you have a 20-year term. Affordability is always going to be a consideration for those applicants. They tend to have, not in all cases, but certainly in my experience, they tend to have, pretty sizable deposit because they've been saving throughout their working life. So they can tend to have a 20% deposit or more, which is really useful when it comes obviously to look at rates, which will reduce the rate that you're eligible for when your loan to value is less than 80%. So, and again, a large portion of our clients would be in that demographic. Not all first time buyers, but certainly those who are moving tend to be in that demographic also. And there are plenty of mortgage options out there, with the only restriction being around that term piece, again, to, in most cases, age 70 at expiry.
So tell me, anything else, Martina, that's happening out there? Any like emerging trends or anything that we could perhaps be looking at in the next 5 years in the mortgage industry?
Yeah, totally. And I suppose there is lots of talk of new lenders coming to market. The new lenders that have come to market, in particular Nua and Moco, are offering something really different to the mortgage market. So I would always say there's 10 lenders in the Irish mortgage market. If you just go to one lender, which we tend to have done in the past, we've gone to the lender that we banked with for years and felt that there was a certain level of loyalty, you're missing out on what 90% of the market has to offer. And chances are you're not going to get the best mortgage for you. So actually an increasing number of mortgage applicants are taking their mortgage via broker channels. So again, I'm a broker, so it might seem like a bit biased, but at the end of this year, end of 25, the broker channel was 47% of all the mortgage market. So that's a real big change because it was 27% in 2019. So people are valuing choice more. People are more informed. They're less loyal to their own banks and more conscious of their own money. Like it's, so difficult to make it and so hard, so difficult to make it and so easy to spend it. So one of the big things when people are looking at their mortgages they're looking at their interest rates. They're making sure they're getting best value. They're paying, so much to purchase properties, and therefore their mortgages are much higher. So they're more conscious of the rates they're paying and the lenders that they're taking their mortgage with. And I think, most people again want that digital journey. So our customers all engage with us via our digital channel. They want to self-serve, be self-directed, which is really useful. And they want transparency. They want to be able to see where they are at any point in the transaction. They want a personalized experience as opposed to, I suppose, more so of a transaction just getting through the process. Home buying is really hard. So I think people really value support and advice now when it comes to their mortgage and the legal element of home buying. So they would be some trends that I would see in terms of rates and lenders. The market, actually, we're a nation of fixed rate mortgage holders. 91% of all mortgages that are outstanding in Ireland are on variable rates or fixed rate terms up to 5 years. And this tends to be because there aren't a lot of lenders offering good value on those longer term fixed rate products. But certainly that is the space we fit in. Most mortgages are on 3 to 5 year fixed rates. People, when they take out a mortgage initially, want to really have that certainty over repayments. So what that means, though, is that we are, more vulnerable to rate increases. There is more churning of our mortgages in terms of like you roll off a fixed rate more often. So I think more and more and increasingly you will see that, like last year, mortgage holders are really looking at their rates and switching. So we had a 52% year-on-year increase in mortgage switching last year. So again, it kind of brings us back to that whole piece of where we're not as loyal to our bank. We are looking after ourselves, and there's certainly more of an appetite for mortgage switching and reducing what is for most their largest monthly commitment by reviewing rates. And again, then in terms of just lenders, there's something for everybody really in the market right now with the new entrants, Moco and Nua in particular. They've brought in lots of different products that are very niche, and again, that were probably underserved by the larger lenders and the incumbents in the market. So they would be around, self-employed applicants or people on contracts. They're flexible in terms of overpaying your mortgage. They offer remortgage products that are more flexible than any of the lenders that are in the market presently. So while we still have, I suppose, three major lenders, the pillar banks, AIB, Bank of Ireland, PTSB, who do the majority of mortgage lending, these new lenders that are coming to market certainly should be looked at from the point of view that they are challenging the banks. They are trying to disrupt the market. So they're offering, more and different products and also criteria to people on the market. So certainly, I think there's a greater awareness that it's not just going to your own bank or your own branch that's important. It's looking at the wider mortgage market. And I think, again, if we look at where the government schemes are, certainly we've seen far more traction on the Help to Buy was always a very popular scheme, but certainly on the First Home scheme, people are seeing the benefit of it. They're less skeptical of it than they were when it was first introduced. Any type of shared ownership scheme needs to be understood fully. But really, this is a scheme that's a government scheme. So it is very friendly towards the participant or the applicant. There's no great interest rate. It's a service charge from year 6. And it only needs to paid back when you sell the property on death or if you move outside the scheme. So I think there's a change in the market. People are struggling to purchase homes. They're using more of the schemes that are in place. They're questioning more about what lenders offer what, and all lenders are different when it comes to mortgages. So I think people are becoming a little wiser to that, which is really great to see. And they're challenging the norm and they're asking more questions and they're looking to pay as little as possible on their mortgage by reviewing their rates. So they'd be the main trends I would see.